Yes. Yes. Yes.
Okay, sorry about that delay. Um, so as you should have figured out, your midterm scores are already up on Canvas, so you should see the scores. And just note that if you disagree with my with how the TA graded, make sure you contact them directly and arrange a meeting, and then they can perhaps correct your grades if you think you're been denied uh, points. But I will present you roughly my solutions today, and I will also give you an opportunity to get some extra credits because my understanding is that the grades are a bit uh, on the low side, but the average I think still acceptable for graduate students. But just psychologically, I think for you guys, maybe you'll feel better if I give you some incentives to learn from your mistakes. So just to give you a heads up what I plan to do, I plan to give you a chance to correct your mistakes. So if you see from week 7 module on the bottom here, there's a link for midterm self-corrections. So I have already documented all the scores you made for each question on your midterm. So as long as you make an attempt to correct your mistakes, I will give you 2 extra points to your score. So the score is out of 90. I will show you the mean and standard deviation soon, but again, the idea is to give you a chance to you know, correct your mistakes, right? If you realize you made an error, accidental or intentional or whatever, here's a chance to, scan your solution and then document your new solution. And then I will check if it's close enough, then I will reward you 2 extra points in your midterm. So essentially, if everyone does it, everyone's grades just ships up. But those who are too lazy, you won't get the points. Okay. So let me uh, pull up today's slide. I mean, the midterm stuff. So let me give you the information now. It's taking some time to load. Okay, cool. Yes, okay, there we go. All right. So midterm results. My opinion, you guys did well. Maybe I guess again, I usually if you did this well, I would not for like a advanced uh undergraduate course around the same material, I would just like say nothing because it's normal. But for you guys, I feel like you might be discouraged. So I'm gonna try to give you some again, give you incentives to correct your mistakes. So don't feel bad if the average seems low. I think it's actually quite okay. So summary statistics, Tuesdays and Thursdays scores. So some people claim there may be like a statistical significance in mean or median or distribution. I'm telling you there is no difference. Here we see the mean overall between Tuesdays and Thursdays class is around 74, median 75, so it's quite tight, right? I mean, it's quite similar, whether you look at the median or mean. Standard deviation around 7, mean and median between Tuesdays and Thursdays, basically the same. So if you were to run like a t-test or some kind of distributional test, you get no difference. Okay, so for those of you who are concerned that there might be an advantage, there doesn't seem to be one. Okay. Um, again, I don't think that requires any further adjustments to those grades based on discrepancies between these 2 classes. Performance by question. So you guys all did the exam. Some questions were obvious freebies, right? Just like it's in the slides. I did it in class, right? So those obvious freebies are, question 1, even question 9, I think should have been a freebie. Question 5 was a freebie, and question 4 were freebies, right? They were in the slides essentially. So I'll go over each question, of course. I give you I gave the TA's course outlines of my solution, so I'm going to go over those soon. But for the most part, question 1, everyone got right. So I don't know how those people got points off. If you think you got the points wrong, talk to the TA. But I expected everyone to get this one because I went over it. I had several slides on this. So as long as you walk through the algorithm to solve this question, the one I proposed to you in class, you should have got the right answer. Question 4, again, is this arbitrage question, just testing if you can identify an arbitrage, and if so, outline a trading strategy. I expected everyone to get something close to 9, but again, seems like some people don't understand the question maybe. So again, here's a chance for you to figure out what you did wrong. Okay. Question 5 is just straight, definition of GMP. If you knew the definition of GMP, you should have got this question perfect. And lastly, monetary supply contraction, right? That's just the opposite of what we did in class, which was an expansion. So if you just did the reverse of everything, you should have got full credit. So some were close to 9, but still, I think some people lost some points. I'm not sure where, but maybe after going through the solution, you'll figure out what you did wrong. So overall, if you want to see what the median is, 83, 82%. So that's around B, right? That's a B minus. So that's actually good. That's a lot of spread. Okay, it's a lot of spread to work with. So if you have a chance to redeem yourself, there is enough room for you to excel. Again, the midterm is only part of the coursework, right? So it's part of the 50%, whereas the finals a whole 50%. So just because you did B plus, right, or B doesn't mean you can't get an A out of this class, right? So you shouldn't be concerned. So expectations management, of course, if you scored around 78, that's around like 89, 90%, you're doing great, right? So no problem, right? You should, as long as you keep your study habits the same, you understand material the way you understand them now and going forward into the end of the course, you'll be fine. 72 to 74 is around where B minus is, right? That's where the mean and median is. So if you're around here, I suggest you do a little bit more self-study. And of course, end of the semester, I will dedicate a week just going over sample questions from last year. So I'll give you tons of questions to work with, and then we'll just do them in class. Below 72, you need a lot more preparation. So even though it's open book, open notes, I designed the exam so that each question, all worth the same, should take you about 10 minutes each question. So I expected you to finish less than 2 hours. But according to my teaching assistants, you guys took the full 3 hours. So I may have to reduce the number of questions for the final. All right, just to make sure you guys have enough time to complete everything. All right. So if there are errors, please email the TAs, and their emails are on the syllabus. So arrange a time to talk to them, and they're the ones who will adjust the grades, because I don't have you have to grade consistently, and I don't know how they grade, so I can't really give points out unless they say it's okay. So if they made a mistake, make sure they add the numbers right, like the total score. So if they added wrong, you make sure that I can correct it. Okay. All right. So any comments on, I don't know, the difficulty of the questions, the way the questions are written? So you should expect the final exam to be somewhat like this. So I don't like multiple choice questions. I think I don't know. I don't think it doesn't really force you to think. It kind of make things formulaic, and I don't like that. I want people to kind of think out of the box and be creative. I think this gives you, flexibility and room to do that, to express that. So you should expect the final exam to be something like this. So I think I will just add maybe 3 more questions, right? So maybe 9 questions. Sorry, the same, maybe also 8 to 9 questions, but on a different subset of material, right? So Final exam will also be is I will tell you it's comprehensive. I also promise to tell you which type of questions I'll give you, okay, at the end of the semester, so that there shouldn't be any uncertainty about the material that you should study for. Okay. So again, probably I'll increase the points per question, but keep the number of questions maybe 8 to 9. Okay, I think that's fair. So that you get more chances to get partial credit, but it's not going to take you that much longer to finish. Probably the same amount of time as midterm. Okay, so let's go over the solutions briefly. Okay, so question 1 was, as I wrote here, triangular arbitrage. The chain is the following: HKD to SGD to Japanese yen to Hong Kong dollars. And so that's a circle, right? As long as you start anywhere on the chain and circle back, you should get the correct answer. And so this one I started with Hong Kong dollars, but you could, if you should also get rewarded full credit if you started with SJD or JPY or HKD. So yeah, so I don't know. So these numbers, just double check where these numbers are coming from. So when you buy expensive. When you sell the lower number, right? Yeah. So maybe you can write down HKD, SGD, JPY, HKD, and then you can figure it out on your own. You submit your solutions later, or you can wait for this recording to appear on to be recorded on YouTube. Okay. All right. So I won't spend too much on Q1. Q2. All right. Q2. Let's see how people did. Q2, 8, around 8 out of 10. So most people got it. So I'm not sure where people lost points. So let's take a look. So question 2, I believe, asks you whether or not purchasing power parity is satisfied. So as you learn from class, as long as the lines are more or less parallel, maybe diverging slightly, that's okay. Just means that the slopes are different by a factor of Q. Then relative PPP should be satisfied. So I believe from 2003 to maybe 2016, I think that was the answer, right? I mean, what the question was asking for. And as long as you wrote something like, oh, the price ratio trend line slope is roughly the same as this E evolution slope, right? Then yes, relative PPP seems to be satisfied in the long run, of course, between this time period, despite the variations that you see. Question 2 asks if absolute PPP holds. So if you understand what absolute PPP means, it means that Q is equal to 1, right? And or in other words, the ratio between prices and the E line, right? E are overlapping. They should be touching each other. So if you look at between 2008 and 2009 and 2000, there's a typo here, 2010 and 2011, you should see that they touch, right? So these points, you should say something, right? That when the lines touch, that's when Q equals 1. That's when absolute purchasing power parity is satisfied. Right? Otherwise, relative. So question 1 is referring to relative, right? Relative PPP. So I hope. So I kind of intentionally made the question ambiguous. You need to write, I believe, something about relative PPP holds, right? Of course, the actual law of one price doesn't hold because these two lines don't touch each other, and there's fluctuations in E over time. Okay, part 3. Part 3, I believe, was a comment on how the Turkish government or Turkish central bank reacted to their economic conditions compared to all other countries in the Eurozone, at least. Whereas Turkey experienced inflation The other countries did not have inflation, but they were trying to, or they also experienced inflation, but they were trying to raise interest rates, I believe, right? But on the other hand, the Central Bank of Turkey was trying to cut interest rates despite inflation. So what's going on? Well, they're trying to increase this, right? And everyone else is trying to decrease this, particularly the Eurozone countries, right? They're trying to increase interest rates, so they're trying to curtail the growth of money supply. So this term becomes more negative, right? Sorry, less negative, so the gap is actually getting bigger, which means that if relative PVP is true, then this value is going to increase, right? That's all I'm saying. So as long as you said something about that, like, right, first things first is relative PPB holds, then we have this equation, right? The inflation rates break down to the following. Inflation breaks down into two parts, right? And the European Central Bank is trying to curtail inflation and therefore increase interest rates, which means the change in money supply is decreasing, whereas the change in money supply of the Turkish Central Bank is increasing because they're trying to grow themselves out of, I guess, inflation or economic contraction, which is a bad idea. But in any case, that's what I was looking for question 3, or part 3 of question 2. Lastly, question 4 was analyzing why there was a dramatic deviation from here. And if we believe, right, our model only tells us that inflation comes from money supply and money demand. But if something else is driving E, right, something else is driving E, then that could lead to a temporary short-term deviation or violation of relative PVP, right? And the example, the reasoning I gave you was that the fact that a lot of the Turkish companies were issuing their debt, corporate debt, in a different currency, namely the currency that's having interest rate going the other way, right? And their currency is getting stronger. So that means if they were generating income in Turkish lira, it'd be very expensive to buy Turkish lira buy euros using Turkish lira, right? And so what they want is they want to hoard euros as soon as possible so they can save up and pay off their debt, which is again denominated in euros as opposed to the Turkish lira. Okay, so in other words, corporate default risk is something we haven't accounted for in our model, right? And so this is driving expected returns on foreign currency, which leads to something weird here, right? So I'm looking for some comment or description of some other factor that may be explaining the change in the change in the spot rate that's not explained by inflation, money demand, real money demand, and money supply, right? So here we have companies looking for a way to insure against default risk, right? That's not something we talked about yet. And that could be driving how E hat E changes, right? And I kind of gave you the hint, right? The hint was companies were issuing debt denominated in euros instead of Turkish lira. All right, so that's Q2. Comments, questions on, so again, 8 out of 10 means most people got everything right, and only people maybe lost 1 or 2 points somewhere, and I don't know where, but as long as you fix that, great. Okay. All right, question 3. Let's see, question 3 was the gold standard. So I kind of expected everyone to get this because I talked about the mechanism quite frequently. So the key assumption under the gold standard is we assume that prices are flexible, right? When prices are flexible, then when you have price changing, that will create the import-export incentive, right? Foreign goods and services are becoming more expensive, then everyone's gonna move away from foreign goods in favor of domestic goods, etc. That's the whole price specie flow mechanism, right? And all this price changes is caused by gold imports, exports. So if you got that down and you understand this equation here, then you should be fine, right? So the part one just asks you to tell me what happens to the real exchange rate. So if you know this, it's very easy to figure out, right? Assuming flexible prices when there's a change in money supply. So if foreign central banks decides to increase their money supply, that's going to raise foreign prices, obviously cause Q to increase, which means that foreign goods and services more expensive, everyone moves away from them and in favor of us, right? So question part two is exactly that explanation, right? Higher relative prices abroad leads to domestic exports, which means gold is imported, right? Under the gold standard. How do you buy things? You have to move gold to the country, convert the gold to the domestic currency, use the currency to buy stuff, right? But when you bring gold into the country, you're creating inflation, right? All right, so that's part two. Part three, you just have to go one step further. Gold creates inflation, increases domestic prices, which undoes this increase in Q, right? Which decreases the US current account. So we come full circle, right? So once we are in equilibrium, if there's a deviation away from our equilibrium Q, whatever it is, then there's going to be a reversal eventually, right? This is what's described as the price specie flow mechanism, which maintains the gold standard. Okay. All right, question four. I'm not going to go over each step, but I think I think everyone got it right. Let me see what you got. Okay, 9 out of 10. So I think maybe somebody lost points on not saying why it's risk-free, why it's arbitrage. It's arbitrage because there's no investment and no exposure to current or future changes in FX rates. So maybe you didn't say that. So I think the question asks you to explain why it's arbitrage, why it's risk-free. And if you mentioned that, if you did not mention that, you may have lost 1 point. I don't know. Also, this question has both bid and ask, just like the triangular arbitrage. So maybe you lost points because you cited the wrong currency, bid or ask. I mean, the wrong quote. Again, just to yeah. So I won't dwell too much on this. You'll see this again on Thursday if you when I release the video. Okay, question 5. I think everybody got right, so I won't again spend too much time. The answer is IM imports equals 50. Savings as a fraction of GNP is 10%. Savings as a private savings as a fraction of GNP is 20%, and government savings as a fraction of GNP is negative 10%. So total savings is 10% as a fraction of GNP. I think everybody got it right. Almost everybody got it right. All right, question 6. Let's see what question 6 is. Question 6 is shock to Y and E. Let me think what the context is again. Charles. Okay, so I got inspired from this idea from reading the news about the recent economic growth patterns between countries around January, February. So what happened was there was economic news in the UK and Japan and how their economy is shrinking compared to the US. And of course, when you have divergence in how the global economy is growing, they're going to have diverging monetary policy. They're trying to stimulate the economy. They're going to cut rates. If they're trying to, curtail the speed at which a country economy is growing, they're going to increase interest rates. So let's see. Question 1 asks you to draw a diagram in which there's a temporary overall. So two things, right? Temporary increase in US real income and a temporary overall decrease in real income in other countries. All right, so we have Y increasing and Y star decreasing. So the way to think about this, well, is do it in two different parts, right? So here you have the short run model, you have an increase in Y, that means the L curve shifts outward, right? So our conclusion is that interest rates should increase, right? And also that we have a stronger domestic currency, right? That's from that one. Y star, we can do the same analysis for the other countries, but the L curve is shifting inward, right? Which means foreign interest rates are going down, right? And yeah, that's the first takeaway, right? And here our interest rates is going up, right? And so if you want to combine these two graphs together, I believe there should be UIP shifting, right? And with lower. All right, I won't write too much here because I don't want to give it away because you guys can work on it. You guys can learn from it. So the fact that R star decreases, you know that UIP curve should change from the perspective of the United States. So that means, so imagine this is the original curve, then that's shifting downward, okay? So you draw something like I just draw here, right? You tell me what happens, you tell me which curve shifts, and you tell me what the final equilibrium is. Is the final equilibrium lower E, right? Or what equilibrium interest rates, you tell me, right? Right, so here we have lower E, higher R, and yeah, so show me that, okay? All right, part 2 asks you to analyze only the expectation of an increase in MS star and not the actual change in MS star. So maybe somebody got confused over that, right? So let's assume that there's a belief that there's going to be a coordinated increase in foreign money supply, but it hasn't occurred yet. So all you do is just change expectations. So here we know that there's going to be monetary expansion, which means that interest rates are expected to decrease, right? Which means that we should find a increase in E from the perspective of the foreign country, which is our decrease, right? So remember, for other countries it's the reverse, right? So if foreign countries decline here, that means that our IHAE, we should expect the currency exchange rate to go in the opposite direction. So if they're going to devalue their currency by printing more money, then that means our currency is going to get stronger. And if it hasn't happened yet, then only expectations change, right? And then you tell me what happens to the UIP curve. UIP shifts further down, and so our currency gets even stronger, right? All right, so think about that. If you made mistakes, I don't know how the TA is graded, but that's what I was looking for. So again, question 1, you do the shifts, you realize that UIP curve has to shift, and the L curve has to shift for the United States. Part 2, you shift IHAE and the direction, which indicates expectation of future MS star increasing. Only the expectation, not the actual change in MS star. All right. Question 7. So I'm just going to show it to you here. I'll read the question too, I guess. In the long term, a temporary decrease in money supply will lead to an increase in domestic interest rates and the depreciation of the foreign currency, all else equal. So long-term and temporary don't go together, right? Because temporary stuff are transitory. So it's a trick question. It's a trick statement, right? Anything in the long term doesn't matter for temporary policies. So temporary policies are reversed. Part two, purchasing power parity suggests that countries with high domestic inflation rates should experience a high rate of real exchange rate depreciation relative to the currency of the countries with lower inflation rates. So if you read that, it probably means, to me, it means nonsense, right? Because I know for a fact that if PPP is true, the real interest rates are the same. Why? Because we said that QE minus Q equals 0, which we also know is equal to R minus R star, right? This is the real interest rate. We proved this in the slides. So if that's true, then real interest rates have to be the same. So it's nothing to do with, yeah, whatever was written. Part three, under the gold standard, country could undo or sterilize inflation effects of gold imports through monetary expansion. No, right? No, because if there's inflation, monetary expansion would make the inflation even worse. So you're looking for something about deflation, right? Or contraction, money supply contraction. Right. And then 4 and 5 are true. So I won't comment on those. Question 8. Let me see, question 8. How people did on question 8. Shock to Y. Shock to Y. Context. Okay, so it's about China experiencing economic contraction. So it asks you to do just a shock to Y. So ignore everything we learned last week. Okay, just only think about the financial markets and there's a change in Y. None of that feedback stuff matters. It won't matter today, but not for this exam. So just a temporary change in Y, that's easy to analyze, right? It's just this, right? You just do that. Interest rates go down and your home currency gets devalued, right? That's part one, right? Home currency gets devalued, interest rates go down, and you can describe the way in which, I think it asked you, did it ask you to explain? All right, anyways, you could also explain how equilibrium is achieved, right? If there's an income shock, people are saving money, they're converting their liquid cash to illiquid assets with higher returns. That includes bonds. That pushes up bond prices, which pushes down bond yields, which explains interest rates go down. As interest rates go down, carry traders notice that there's a gap between R and R star. They will borrow domestic and convert those domestic currency to foreign currency, and that's going to devalue your currency further, right? That's literally every step of the model, right? Okay, so 2, a permanent change in Y. So when we talk about permanent stuff, we're talking about changes in expectations. So if you see this, then we know that there's going to be a change in E hat E, right? For sure. So just based within this framework that maybe people get, I don't know, there's going to be a very long-term negative productivity shock to China, and what's going to happen. And if you do everything right, you should see that UYP shifts up, leading to an amplified E. And then since we're not talking about prices, right? So everything's already in the real sense. You would just say that's what's the final intersection is there for the long run equilibrium. So all that price chasing, the change in MS, all that stuff between short run and long run, it only applies to monetary policy. Here we have a real income shock, right? Again, the idea is here in this context, it's politically not acceptable for maybe some Western countries to do significant trade with China anymore. That's like a real thing, right? It's a real income shock. Nothing to do with money supply creating deflation or undermining inflation, etc. All right, so that's what I was looking for from Q8. So you have something looks like that. You should get something close to full credit. Question 9. See slide 29, lecture 4. Just do the reverse. Do the analysis backwards. I mean, the opposite direction. That's literally the answer. Okay, so that's why I call it a freebie question. Okay. So I remind you again, there's going to be an opportunity to give yourself 2 extra points. Just correct your mistakes. I will just briefly look over whether or not you've made corrections. And if you did it more or less correctly, I'll give you 2 extra points to your exam. Questions or comments about the midterm? I will post the slides on Thursday, okay? So you have no excuse if you want the points. So week 8, so you had a quiz last week, so let me go over that. Our objective for today is to introduce to you policy analysis under the new framework, which is the extension of the short run model, but now we have modified it so that it incorporates the real economy. So the big picture question is, why do we care so much about the macro side? Well, to fairly price something, hopefully you learned from your first semester class, we must have a sense of equilibrium, right? There's no forces that's driving that's going to create instability, right? Because nobody has incentives to come in and try to exploit something. No carry traders don't want to come in and change the price. Money supply equals money demand, meaning there's no gap between supply and demand. And same thing for the real economy. So when we have equilibrium across all markets, that's when we can actually fairly price something. And the key objective here is to price foreign currency returns, right? And that's why we have such an extended model. Today, we're going to talk about monetary expansion and fiscal expansion and temporary and permanent versions of it under the AA and DB schedules, right? So let me go over the quiz first. The quiz questions from last week, I think almost everyone got perfect scores. So let me just briefly talk about the solution. Which of the following choices best describes the effects of consumption, investment, net exports that would result from an increase in the price level, other factors held constant? So we have an increase in price levels. We know that consumption is based on Y minus T, right? Disposable income. So if there's going to be higher prices, but our income is at the same level, that means it costs more, right? It costs more. So in the real sense, Y minus T is as if it's decreasing. So consumption is going to decrease. So based on your choices, A is wrong, right? Because it says increase. Next one, investments. Again, if you think about just price levels and we're not talking about inflation, we're just talking about just a jump in prices. That means buying physical capital, for example, is more expensive. If that's true, then on average, you should expect investments to also decline, or in aggregate should also decline. So just based on those 2 observations, A and B are out, but you can also look at the last one, net exports. Well, again, net exports is CA, function of Q and YT, right? All else equal, if Q is constant, but disposable income is suddenly lower, then we should expect people not to import as much anymore, right? So there should be a decrease in, sorry, let's see, increase in price level. Yes, so our prices become more expensive. Sorry, not. So this is something else, but just for Q, okay. If our prices get more expensive, we should expect Q to decline, which will lead to a decrease in CA, right? So C is I believe, the best answer given the choices. All right. Question 2, which of the following factors is most likely to increase aggregate demand? Aggregate demand is Y minus T, I, G, and Q. So if you increase in real interest rates, that only goes in here, but we know that if you increase real interest rates, that's going to lead to a negative. So I talked a little bit about this, but you can skip it if you're unsure, that's fine. But anyways, decrease in I will lead to decrease in D. B, an expected decrease in future prices. So if future prices are expected to decrease, then it's as if you can think about it in the same way as Q increasing, right? Because E is going to be, I mean, P, right? P is going to decrease. So which will increase Q, right? Is EP star or P. And lastly, an increase in real wealth. Well, we know where real wealth comes from is here. So up, right? So C is a direct answer. Everything else is well, expected decrease in future prices. All right. So maybe not this way. Sorry. An expected decrease in future prices. I would put a question mark here, but anyways, between A, B, and C, I think C is obviously the obvious answer here. So increase in real wealth will lead to increase in aggregate demand. All right, question 3, when national income and an important trading partner's economy increases, aggregate demand in domestic economy is most likely to what? So if your foreign trading partners is becoming wealthier, so we should expect, I mean, we know that Y star is increasing. What's going to happen? Well, let's see. Aggregate demand in the domestic economy is most likely to not decrease, right? Because we know that if Y increases, that's going to lead to, let's see, an outward shift, which means interest rates go up, right? Which means their exchange rate is getting stronger, correct? They're getting stronger, which means our currency is getting weaker, which means our exports is going to be better, right? So we should expect our economy to, aggregate demand to increase, yes, because foreign consumers will tend to buy more exports from the domestic economy, correct? Right? So everything else is wrong because decrease is the first thing that is mentioned. So A. All right, so with that out of the way, let's recap what we learned from last week and then talk about fiscal policy and fiscal policy and monetary policy with the A and the D curves. So last week we concluded on this graph, right? This graph is a representation of 3 markets or two markets, financial markets and the real economy. Financial markets is represented by one equation, which is MS equals P times L, but now we replace R with the UIP to condense everything into one equation. That's represented by the AA schedule, because now we're plotting exchange rate against output, because we want to know the relationship between E and Y. We also learned that the AA schedule is downward sloping because as we increase Y, E has to move in the opposite direction to maintain equilibrium. So it's called a schedule because the combination of E and Y allows this equation to be true. The DD schedule is our way of modeling the real economy in terms of aggregate demand. We only model demand because we expect supply to always change to meet the needs of demand. So we're only modeling the demand side. We notice that there is a feedback effect coming from income, right? From Y minus T. But the way the relationship between E and Y and D, however, is the opposite. So it's not a negative relationship, it's a positive relationship. And the idea why it's positive is because as E increases, Q increases, which increases the current account, which increases demand from abroad, which increases output, right? So the aggregate demand function is positively, sorry, the DD schedule has a positive slope when plotting E against Y. Again, the idea here is because devaluing your currency helps exports, right? From a demand, from the real economy, a real commodity sense. All right, and so we get an equilibrium across all markets only when these two equations are satisfied, and that occurs exactly at the intersection between the AA and DD schedule in this graph. And in the back of your head, so just solving graphically, you don't have to, walk through all this economic intuition. You just look for the intersection and figure out how to shift curves. That's all you really need to do. But the intuition, if you want the intuition, to understand how we achieve equilibrium, it's through the following sequence of logic. You start with the financial markets. How should the financial markets react first? That's the first thing you should think about. After the market finds an equilibrium, after the financial markets finds an equilibrium, how do we approach from that equilibrium to an acceptable equilibrium that allow us to clear the real economy? So, I concluded last week that if we have for example, an irrational change in equilibrium to this point here, for example, what happens first is financial markets clear first, which means that we drop onto the A schedule first. And why? Because carry traders will notice something doesn't make sense. They will try to maximize expected returns. And that's why we will achieve equilibrium first in the A schedule. But we are out of equilibrium with the DD schedule in this case, in which case, as something changes, in this case, as E is too high, right? That's going to drive exports. And as exports increase, Y is going to increase. But as Y increases, our E must shift in a direction, right? And ultimately, that allows us to achieve equilibrium on the DD schedule. But notice that we're moving along on the AA schedule, right? We're always in equilibrium on the AA schedule, but we have to move towards the DD schedule such that all markets clear because of this Y feedback, right? Y occurs not only here, but also here. So it will become clear why this is important once we talk about these different policies under this type of extended model. Okay, so our two objectives are the following: to analyze the shifts in the DD and A schedule for a temporary policy, and also changes in policy under a permanent scenario. All right, talk about this. Okay, shifts in the DD schedule and AA schedule. So the previous slides, I think I mentioned already. Yeah, I mentioned already, so I won't talk too much about. I won't talk about it now because I already mentioned it. So in this slide, I tell you what the DD schedule represents. And here I talk about what the AA schedule represents. And now I want to talk about how to shift the A and DD schedules. Okay, so the way we shift these curves is exactly the same way we shift the curves in the short-term model. If we're changing a parameter that's not on the axis, then you should expect to change something on the graph. Move something on the graphs. So in the case of a DD schedule, the way to think about this based on this based on this suggestion, you don't have to hold E, you can hold Y, but I think to make things clear, let's just hold E, okay? So what you should do to figure out how to move the DD schedule is fix E, and if we change I, G, or the current account function, or P star, in the upward direction, you're going to notice that the DD schedule is going to shift east or to the right. So let me tell you how that works really briefly, because we're going to do this again, but just to give you an idea what's going on. DD schedule is upward sloping, right? Holding E constant is as if I'm drawing like a horizontal line, right? I'm holding E constant here, right? So holding E constant, oh, so that's not Q, that's Y. Holding E constant, if I decide to, for example, increase G, then D is going to be increased. Again, example. Government wants to prop up the property market, so they buy a bunch of property. Okay, so that stimulates the house building industry, right? And therefore D increases. Cool, right? Then you get this. Keynes says, according to his model, if you have aggregate demand exceeding output, output will eventually increase to meet the demand. So Y has to increase. Okay, so holding E constant, I increase G, which means that for this E, this point must shift away from the origin because the x-axis is Y, right? And this is 0. So this point must move to this point. Agree? But I chose the E arbitrarily, right? I chose an arbitrary E. So no matter which E you hold a constant, if I increase G, the DD curve, that point on the original DD schedule must shift to the right. So we get a rightward shift schedule. Make sense? So hold E constant, change I, G, or CA, or P. If it's upward, then it's shifting the DD schedule to the right. If it's decreasing, it's shifting to the left, right? Because the Y value must go down in the other direction. So if you increase taxes, if you increase P, it's the other direction. Why? Because it's minus T, right? It's negative. And P here is not in the numerator, it's in the denominator. So if you increase that, that also hurts your demand. So it's going in the opposite direction in the first bullet point. Make sense? All right, so a schedule, same idea. I don't think this is necessary, but let's just do it. So a schedule sloping down. We are still plotting E against Y. But instead of my suggestion, you don't have to do it this way, but my suggestions for the A schedule, let's pretend we're holding Y constant. So it's as if we're drawing a vertical line because we're starting at this point. We are going to, for example, let's say increase MS, fine. Let's increase money supply. That will create an inequality in this direction. All else equal, the only other parameter that I can change that's not held constant, that's or on the axis is E. So E has to move in a direction that allows L to increase, and that's only if R decreases, which means E increases, right? Because E increases, R decreases, L increases. So this point jumps to here, right? A prime. So that's how you shift the curves, right? So if you're reminder, if changing a variable that's not on one of the axes, then a curve or a schedule will shift, right? Otherwise, we are moving along a curve. All right, let me give you an example now, like a real example. Suppose we are going to study the following. Let us now study a temporary change in monetary policy. I believe we're doing monetary policy first. So two different types of policies. I already mentioned already. First one is monetary, which is the change in MS. Fiscal policy refers to only two other parameters, which is G and T. There's a difference, right? One is a direct spending that comes from the aggregate demand function, because that's where G and T comes from. MS comes from the financial markets, right? So it's going to be different. It's going to have different effects. The mechanism is going to be different. So reminder, temporary means that this policy will be reversed in the future. So there are no long-term expected, there's no long-term changes on anything, right? So no change in EHADI. One additional assumption, I think it's harmless. So we're going to assume that domestic policy shifts do not influence R star and P star. So just pretend that when we do the analysis, we're holding all other variables constant. So just presume that they're not functions of each other. Okay, so temporary monetary policy, we already know what this looks like, right? We know that in this format, if there's a monetary expansion, interest rates must decrease. And we know that exchange rate must get, the domestic exchange rate must get weaker, right? And all I'm going to show you is that this graph can be translated to the AADD schedule, and you can see the same thing. Because E changes, PPP will fail in the short run, right? Because Q says that it's relative PPP says Q is constant, but because E changes, Q will change. In which case, we're going to allow relative PPP to be violated. But we're going to allow, in the long run flexible prices scenario, we're going to try to allow Q to be equal to 0. I mean, constant. We'll do that later. All right, so let's go ahead and do everything on the A schedule now instead of the T, right? No longer the T anymore. So to do this analysis is the same. We're going to have a starting equilibrium. Suppose we already have a stable equilibrium, all markets clear, and we're going to shock it. In this case, we're going to shock it with a change, an increase in money supply. So here we have a schedule. Here we have B. What does the A schedule represent? It represents MS equals P times L R star plus, I'm going to write E hat E over E minus 1 just to make things simpler, right? So I hope you know why and why here, okay? DD is Y equals D, Y minus T, I, G, and EP star over B. So suppose we have a starting point here. So this is Y naught. This is E naught. So let's walk through the mathematics, just the equations. If we have an increase in MS, that's going to distort or create an inequality. holding y not constant, holding y constant, we must move L in a direction that restores equilibrium, because that's what we're looking for. How is that possible? Well, this entire expression has to decrease, which means that this value here has to increase, right? Increasing the denominator will decrease the value of the fraction and allow us to get a lower interest rate, which allows L to be higher. So what I just said is the following. If I'm here, I must have a higher E if I have a higher MS. So in fact, every point on the A schedule must shift out, right? Okay, so, but we're not, that's not the whole story, right? That's just shifting curves and say, okay, well, this is the equilibrium, right? This is the new one. But why? Why is that the case? So let's walk through what happens. So what happens is for that given y naught, we must have a higher E. So we're here, correct? But with a higher E, that's going to go into this term here, right? With higher E, we must have higher Q, which means more exports. We're more competitive in our exports, which means aggregate demand is going to increase, which means there's going to be an inequality in which supply is lower than demand. So over time, we should expect Y to increase, correct? So if we're at this Y, why not? And we suddenly jump up to this point here, because again, market clearing, right? Markets react first. For this given E, let's call it E prime, we must have a higher Q, which means our exports are more competitive than before, which means that output is expected to increase over time. So we're actually moving this way, right? Because this way gives us higher output. But as Y increases, that's going to feed back into here. Agree? And if you walk through the logic again, what this tells you is that with higher Y, E doesn't have to increase that much anymore. So that's why we're moving downward, right? With higher Y, E doesn't have to increase as much anymore. So it only increases up to this point here, in which everyone is satisfied. So that's the chain of logic. So let me go over that again. Step one, which parameter is changing? It's MS, right? MS is changing. MS is changing. So we learned from the short run model up to week 4 that if MS is changing, that means real money supply curve is shifting down, which means that interest rates are going down, which means that carry traders are going to try to devalue the currency by converting domestic currency to foreign currency, which means that for that given Y, for that given output level, we must have a higher, more devalued currency than before, right? So that's why we jump from this point to here. As I mentioned earlier, financial markets always react first. So we're on the AA schedule. But at this point, this E prime and this Y naught, that's not an acceptable equilibrium for the real economy, right? Because with that output level, let's say this is Y naught, right? At that output level, but at this E prime, which is bigger than E naught, this value, the Q, the real exchange rate, is higher than before. With higher Q, that means that foreign goods and services are relatively more expensive. And so international trade is going to move away from them and toward our exports instead. That means aggregate demand is going to increase. And based on the Keynesian model, With higher aggregate demand, output should increase over time. And indeed, if output increases over time, that's going to feed back into this AA schedule equation, which means that E actually doesn't have to increase that much anymore. Because as you increase Y, that's actually going to dampen the E. So that's why we're moving along the AA schedule. So what I'm saying is, if you increase Y, E has to decrease, right? That's what AA schedule means. So that's why we're moving along this schedule until we intersect at the D schedule, in which Y equals D, and that equation is satisfied, right? Comments, questions? So now you have a mapping from the short-term model you learned from up to week 4, and this is now what it looks like with a complete model that connects the real economy with the financial markets. And now the difficulty part, I think, is this feedback stuff. It's tricky. But I think if you walk through yourself several times, it will become very, I think, intuitive. All right. So one more thing, one more example, or one more case I'm going to go over before we take a break. So here we have a temporary fiscal expansion. So two types of fiscal expansion, as I mentioned earlier. We can expand fiscally through a tax cut. So that's as if people can keep more of their wealth, right? And the other way is if the government acts like a household itself, right? They spend money. Maybe they decide to, I don't know, invest in a certain industry. They want to start a new university, anything like that. So these things will all increase aggregate demand. So the difference, however, we note is that if you do a tax cut, it's going to be nominal tax cut. And so some of that money might be saved. So if we do a tax cut, I will typically write a small c in delta t, because we're talking about only the part that's not saved, right? That's the small c. So the part that's not saved, that's spent on consumption, that's going to boost aggregate demand. If the other part is saved, so it's not going to change anything. So the takeaway here is that with increased money demand, it's going to raise domestic interest rates. And with higher domestic interest rates, nominal real exchange rates, again, will fail. And actually but it's going to fail in the other direction. It's going to fail in the sense that Q is going to decrease. And this is going to undermine export competition. So there's going to be partial offset on output. And I'll show you what that looks like in a graph. So again, let's begin with a starting point. Let me write MS equals P times L plus minus 1. And the DD schedule, Y equals D I G EP star over P. This is Y naught. And this is E naught. All right. Let's do a fiscal expansion. So let's just do G. If I were to increase G, the way to think about it is let's hold E constant. So let's imagine there's a dashed line here. And we are starting point here. And we want to increase G, which means aggregate demand will increase, which will create an inequality. But if Keynes' model is correct, then output will increase to match demand eventually. So Y has to increase. And that means that for any G that increases, all else equal, you must have a higher Y. So we must move from this point to here because we chose E not arbitrarily. Because the choice was arbitrary, that means any point on the original DB schedule must shift to the right. So write DB prime. Okay, so if E did not change, if E doesn't change, right? If it's stuck at E naught, we can actually achieve the full potential of fiscal policy, right? Then we can actually get here if E doesn't change, correct? So that's the full potential of fiscal policy. However, if we forget, we should not forget that if we change Y, that's going to affect this equation here, right? So we're going to move along the AA schedule to this. So to summarize what's going to happen, we're going to move along the AA schedule until we intersect exactly at this point here, E prime. I'm going to call it E prime. And we notice that this point here, Y double prime, is less than Y prime. The reason it's less is because our currency has strengthened in value and undermined our export competitiveness, right? That's what's happening. Why does it change? Well, if you increase Y, then that's going to elevate liquidity preference, distort inequality. We need to restore it. How do you restore it? E has to move in the direction that allows this entire parameter here to increase. And that's only possible if this value decreases, right? Because we want higher interest rates. So that's only achievable if the denominator decreases. So a stronger domestic currency will therefore allow us to restore equilibrium, but that's going to feed back. This is going to feed back here, right? So what does that say? It's saying that, okay, if we have a fiscal shock, positive shock, all else equal, yes, aggregate demand is going to be higher no matter where we start. But as Y increases, that's going to feed back into the financial markets. Financial markets going to interpret that as, well, that's going to make interest rates higher, but that's only achievable. That would mean that our currency has to become stronger. With a stronger currency, however, that's going to dampen the effects of the increase in Y, right? Because with lower E, that's going to lower Q, right? So Q is being undermined, right, over time. So even though there's an increase in G, there's actually a slow decrease in Q. So your Y is going to be dampened over time. So this is where the export competition is crowded out, right? So let me say it again. We will observe that, see there. Yeah, I've wrote it somewhere, but anyways, fiscal policy will lead to a stronger domestic currency, which will crowd out the current account effect, right? The stronger currency will crowd out this effect, right? So this example is like a indication what's to come, right? So we learned from the up to week 4, when we have a permanent monetary expansion, there's an amplification effect on E, right? That's going to be good, very, very good for export competition because it's moving in the direction that we want. But for fiscal policy, if it's permanent, it's going to be very, very bad for output because it's going to strengthen our currency instantaneously. And that's going to completely wipe out any possible output competition, like output that's coming from competition. Okay. Or trade competition. So let me walk through it again and then we'll take a break. So we have a starting point here. We increase G, which distorts the aggregate demand function in favor of the right-hand side, creating inequality. Keynesian model says supply will meet demand, so we should expect Y to increase. Increase in Y, however, feeds into this financial markets equilibrium equation, which creates an inequality that's only able to be restored if E decreases. In other words, if Y increases, E has to decrease because we're moving along the AE schedule, right? But as we move along the AE schedule, the decrease in E will feed back into Q, right? Which means Q is decreasing as we're increasing Y. So there's a dampening effect on Y as we move towards the intersection. So in the end, we are not achieving our full potential because E is crowding out output through the current account. So we get this effect, Y double prime, as opposed to Y prime. So this, however, is achievable if you have a fixed exchange rate, right? Like Hong Kong. So imagine you're Hong Kong and you're always maintaining a pegged exchange rate, which means your exchange rate doesn't change. Then actually fiscal policy is very, very effective, right? That's the takeaway here. Fiscal policy, very effective for pegged exchange rate regimes, very bad if you are concerned about your exchange rate in a flexible exchange rate economy like the US. Okay, so we'll talk about permanent stuff, which is a bit harder. So in the examples here, it's all the time. I'm only showing you the short run equilibrium, right? Because in the long run, all this stuff is reversed. So we're just back at here, just to make sure we're on the same page. Everything is the same as the other model. It's just expressed in a different way. So here, same with fiscal policy. Yes, you get this crowding out effect in the short run, but it's still, at least it's still a positive effect, right? But in the long run, it doesn't matter. Okay, nothing. You get no long run output effects in the long run. Okay, so let's take a 10-minute break, and then we'll reconvene for the permanent stuff. No quiz today. So. You're from Thursday class?
Yes.
Last name?
L
姓什么？
D L I
李什么？加
李小妍。哦，thank you。
黄王什么？立胜。你是 Thursday or Tuesday?
Tuesday, but took the exam on
let's start.
Thursday.
Yeah.
Maybe they have my classmates to take the exam papers.
Do you have permission? Like,
Yeah.
I think just okay. Yeah.
WeChat methods.
Okay, sure.
Uh,
Okay. Thursday.
today, Tuesday. Chen, yeah. Yeah, thank you. And another one, also the gift, to ask you. Yeah, thank you.
I'm not clear, very clear. It's about this choice. The choice B is wrong because there is volume effect and radical. That
Expected decrease in the future price. I guess it could increase. I think the confusion, I think it's not a good answer because
Yes.
we're talking about future prices, not actual prices.
oh,
So there's actually no change in demand, if you think about it that way.
oh,
If I had to choose between B and C, I think C is,
the best.
yes, obviously, yes.
Thanks.
All right, let's finish up. So slide 31 summarizes what I just talked about before the break. Monetary policy can offset output shocks effectively. So that means that, so imagine why you would care about monetary policy, fiscal policy to begin with. You perhaps think there might be a recession coming, or you might think that maybe you have to boost a certain industry in order to remain competitive among your trading partners. Either way, you have to kind of time these events such that these shocks directly address the problem at hand. So the two policy tools that you have at your disposal, monetary and fiscal policy, have different kind of trade-offs. Monetary policy can have an effective output, but that shock, however, requires you to devalue your currency. It's effective if it's just a short term, but if it's fully anticipated, you can think that only creates inflation in the long run, right? So we'll talk about that later. Fiscal policy, on the other hand, under flexible exchange rate regimes, can also offset output, but there is a competing effect, right? Coming from the fact that Q changes, right? Q changes in a direction that doesn't help you. With Q decreasing with fiscal policy, fiscal expansionary policy, that's going to crowd out to your output effect, right? Because the current account is going in the opposite direction than your aggregate than what you want from your aggregate demand. And as you'll see in the permanent case, fiscal policy actually becomes quite bad, especially when you're in a special case in which R equals R star. Okay, so when we are in that scenario, you'll see that things get really bad when you conduct fiscal policy. So timing, as I mentioned, despite these tools, you might think, oh, they're great. Why not just keep using it? Well, it's not always the case, because you have to identify the problem first, right? If you think there's a recession coming, but it doesn't come, then you might just make things worse, right? Create inflation, for example. So there may be a time lag in the identification of certain negative shocks that you want to counteract, right? And you also have uncertainty about its duration. So how long do you have to maintain this temporary policy before you unwind? And secondly, there may be a time lag in your implementation. So just because you identify a problem beforehand, let's say you can predict a recession, how long does the effects of monetary expansion translate into actual real effects in the economy? That's hard to measure, right? You have to be, I don't know, quite skilled and experienced central banker to know that. All right, so it's not a cure-all, is what I'm saying. So just be aware. Problems with these effectiveness. So for monetary policy, as I said, if it's fully anticipated, that means it's already captured in E hat E, then it may have nothing. If E hat E doesn't change, right? That just means that your monetary policy shock may not be as effective as you would like it to be. For fiscal policy, if your expansion recovers issuing new debt, right, because you have a budget deficit, issuing new debt may actually undermine investment. So in this class, I said investment stays constant, but just note that if a country needs to issue more debt to spend more money, because that's how you spend money, you need to borrow money to spend money. If you issue more debt, investors would prefer that debt over investing in risky ventures. In which case, decreasing I will lead to a decrease in D, right? But in any case, in this class, don't worry about this instance, but just note that the effectiveness of these two policies, again, there's trade-offs. While monetary policy under flexible exchange rates seems like it's quite good, just note that if it's fully anticipated, then that will dampen or weaken the effects on E, or on output. For fiscal policy, if your government is running a deficit, the fact that you have to issue new debt to spend money may actually undermine your overall output, because decrease in investments may decrease aggregate demand. All right, so we're going to now shift gears to permanent policy changes. So we're thinking about things that persist, policies that persist far into the future, in which case E hat E must change, right? So E hat E has to change. So permanent policy,
means that these policies are forever, they're in place indefinitely, and therefore E hat E has to reflect that permanency. We will assume that a permanent fiscal policy will have no effect on domestic prices, but it will affect the spot rate, as you will see. Okay. Furthermore, we will still assume that domestic policies, so domestic monetary and fiscal policies, will not affect foreign variables. Okay, so R star and P star are still just, untouched by the fact that we implement these policies. So to summarize monetary policy expansion, we can decompose it into long-term and short-term effects. So you already know these results, right? Based on week 4 example, you get an overshooting in the short run and a reversal in the long run. And we can show this again in this model, in this framework. But the extra step now is the fact with the DD schedule, I can now show you how relative PPP will hold in the long run, right? I want to show you that QE minus Q is 0, or in other words, Q is constant, right? I can show that to you, and I can show you using the A and DD schedule. So in the long run, under a permanent monetary expansion, to summarize again, short run overshooting because there's an amplification effect with the change in expectations because it's a shock, right? Your expectations have to change, reflecting a permanent shock. But you get a reversal because prices will catch up to the change in money supply, but our expectations are still elevated. So we still get a change in E, but the change in E is not as exaggerated as before because prices have caught up to the change in MS. And additionally, in the long run, you note that the aggregate demand function has prices in it. So if P and E move together, as we talked about a few weeks ago, in the long run, as price changes, E spot rate has to change proportionally too. Note that Q equals EP star. If P changes by some factor, then E has to change by factor, and therefore in the long run, Q stays constant, right? That's the takeaway, right? If P change, so short run to long run, short run, P stays constant, but there's a change in MS. Long run, prices are flexible. P will catch up to the change in MS. And also, as we learned from the 2 weeks ago, E also must trace prices. And if they trace proportionally, then Q is as if in the long run, Q didn't change, right? And so there's no change in Q and therefore no change in aggregate demand, and therefore output change is 0, right? In the long run. Okay, so let's do that visually now, okay? So we have a starting point. That. A schedule is represented by x plus p times L plus y plus 1. D schedule y plus D. EP star. So we are doing a permanent monetary policy. That means increase MS and increase in E hat, right? So let's do that together here, right? We have this parameter increasing, this parameter increasing. So we know that just this one, it's this way, right? Inequality favors the left-hand side greater than the right-hand side. With higher E hat E, that's higher interest rates, which means L is lower, which means that the gap between MS and price times liquidity preference is much larger than before, right? So in order to offset that larger gap, E has to move in a much exaggerated way than before. So how do you undo this increase in E? Well, you increase E, right? So for any y, right, any y that we choose, we just choose any y, let's suppose it's y naught. We must have an amplified effect because not only is ms higher, but the entire right hand side is much lower than before. So E has to, jump really high, right? So that's the overshooting, right? AA prime. So in the short run, we get an output effect, amplified output effect at y. So we can walk through the feedback together, right? So we go from this point, we jump to this point here, right? For this given y naught. So we have a very amplified effect on E, right? Let's call that E prime. But this E prime, this increase in E will feed back here, which will increase Q, which will mean that our exports become very competitive, which means aggregate demand is higher than before. In the long run, I mean, over time, our supply will meet demand, so output will increase. But this increase in output will feed back here, right? And as y feeds back in there, our E doesn't have to increase as much, right? So increase in y here means decrease in, right? So that means we're moving along the new AA schedule towards a satisfying point in which all markets clear. That's E double prime. So I won't talk about the carry trader stuff. I assume that the mechanisms are all super clear. I think the things that are confusing is just how to think about how to get from one equilibrium to another equilibrium, right? So in this case, the rule of thumb is the following. You get on the AA schedule first, and then you think about how we move towards an acceptable equilibrium on the DD schedule. So here we have monetary expansion. What does that look like? Graphically, it's an upward shift of the AA schedule because we have to have an amplified effect on E given any output level, right? Once we have that amplified E effect, that E will feed back into the aggregate demand, requires more exports, requires more output, but as output increases, that requires a dampen effect on E. So our currency doesn't have to be as devalued as we want because we need to move along the A schedule towards an acceptable equilibrium point. All right, so this is our short run equilibrium. Okay. So question on the exam asks you to identify, that's all you have to show. Okay. Of course, it would be clearer if you explain a little bit what goes on. Like the overshooting, I mean. Okay, so long-term effects, we all know. Prices will catch up to money supply, overshooting, reversal. But now we have an aggregate demand function to think about, and we want to impose relative PVP. So let me quickly draw our short run, and then let me combine it with the long run. So our short run was up here, right? Let's assume it's up there. Prime. AA. Oh, just AA. And let's assume that after the long run, we still have elevated expectations. So our AA schedule drops down here. So AA double prime. So your question is why? Why does it go down there? Well, let's look at the equation, equilibrium equation. So there's no more change So interest rates don't change, right? Interest rates don't change anymore because prices will have caught up to the change in MS, but we still have an elevated E, which means that E has to move in a direction that offsets this increase in E, and that requires this E to increase, right? So we still have this gap, right? This gap. Not good there, okay? So this comes from just the fact we only have change in expectations. Okay, so you can imagine that all else equal, we're at this point here, perhaps, maybe. All right, so let's write out the DD schedule to explain to you what's going to happen in the long run. So in the long run, we have prices increasing, right? And that removes the money supply, real money supply shock change, right? But we also need to account for the fact that E will also increase by the same proportion. So if suppose that price levels have already stabilized, so it all else equal. So let's assume that we just have this, and we just have sorry. Yeah, hold on. Yeah, so increase in P will lead to a decrease in Q, which will lead to a decrease in current account, right? So we should have a decrease here. So we should have an inequality like this. What does that mean? That means that for a given E, if we have higher P, we must have a decrease in Y, correct? So remember, how do we shift the DD schedule? We hold E constant, we change the value. So here we have an increase in P, which decreases Q, which means our exports are less competitive, less exports, less aggregate demand. And so Y must reflect that lower excess demand in the future. So which means that our DD schedule will shift. If we're here, for example, we're shifting this way. So maybe let me highlight that this is a short run. All right. But as P increases, so if we're here, as P increases, E will also slowly try to catch up to P, right? So we're going to be moving along the A schedule, as I said before, until relative PPP is satisfied. And that's when Q is constant, right? So we will keep moving along the A schedule until we are, until there is no more output effect, which is this point. So this point is short run, and therefore this point is long run, in which case PPP is satisfied, holds. All right, let me walk you through it, everything again. So in the short run, two things change: money supply, expectations. They move in a direction that widens the gap between the left and right hand side of this equation. And so there must be an amplified effect on the spot exchange rate. So you get a really high jump compared to the temporary case. So permanent case, you get the A schedule moving really, really, really high. Once E moves up for the given output, output wants to move upward. But as you move Y, as you increase Y, E doesn't have to increase as much, right? Because there's a negative relationship between E and Y. And you keep moving in a downward direction until aggregate supply equals aggregate demand. Total output equals aggregate demand. So that's the short run. And now I copy the short run here. In the long run, interest rates don't change. Only thing that changes is expectations. So if we were to write this equation, this financial market equilibrium equation, the only thing that has bite or has an impact is the fact that expectations has changed. So that's reflected by the fact that double A prime shifts down to double A double prime, right? But this gap, so if all else equal, if DD schedule didn't change, we would be here. Okay, so imagine that we're still in we're on the A double prime schedule. And we know that based on long run conditions in which prices are flexible, prices must increase all else equal, right? We want to know its impact on the DD schedule. So for any level of E, if we increase prices, that's going to be undermined by a decrease in export competition, Q, which will decrease D. So output wants to move this way, right? It wants to move this way. But as you move this way, note that E, the spot exchange rate, will also want to increase to chase up to P, right? We learned that, right? E traces P in the long run. So it will keep increasing until Q returns back to its original value, right? So that's precisely where output remains. There's no change, right? Because if no change in Q, then there's no output change, right? So that's the final point. In the long run, monetary policy has no impact on output, which makes sense because prices rise, right? Prices kill everything. Which is reflected by a higher E, right? E double prime. So just for reference, right, the overshooting is here, right? You have E prime here, E double prime. So you go from E naught to E prime to E double prime. So I've combined everything together. Short run model now has the overshooting. You see it here too. Goes from E naught to E prime to E double prime. We assume that E will catch up to changes in E will catch up to changes in P, which will will undo any output effect, right? And so output will be 0 in the long run. So that's the long run analysis of a permanent monetary expansion in the AA and DD framework when we combine financial markets for the real economy. So let me grasp it. Takeaway. Long run. Let's do long run. No output effect. Overshooting. But higher E. Short run. Amplified output effect compared to temporary. And this is reversion. Let me just write reversal here, reversal. And this is overshooting. And here PPP holds. And here PPP violated. Right. Comments, questions on permanent fiscal, permanent monetary policy? All right, this is the easy stuff, okay? The fiscal stuff is gonna get messy. Permanent fiscal expansion. So for permanent fiscal expansion, PPP will be violated in both the short run and long run, according to our model. It cannot be satisfied, okay? And also under certain circumstances, if our starting point is E hat E equals E, or in other words, R equals R. If we're in an equilibrium in which if our spot rate is equal to our expectation, okay, let's just assume that we're in this scenario in which E hat E equals E, which means R equals R star. Output will be completely wiped out. There will be no output effect for permanent fiscal expansion. And I have to prove this to you using some math. Math proofs, okay, math logic. Okay, so here's the proof. So imagine we are in the so-called long-term equilibrium. So that's referring to a special case in which we are in a scenario in which E hat E is equal to E. That means we're in a state in which we are at complete equilibrium. The spot rate is equal to our expectations, and that's our stable point, starting point. Okay, and which means that R equals R star. Okay, right? Because yeah, I hope that's clear. Right. So with that in mind, let's study this situation here. So let me give you a brief picture first, okay? A very simple picture that you already saw. So this is our graph for a temporary fiscal expansion, right? The permanent fiscal expansion is going to impact the AA schedule, however, right? Because under a temporary case, the AA schedule is untouched, right? We don't touch it. We get an output effect and we move along the AA schedule. But the AA schedule has to change in the permanent fiscal expansion case because fiscal expansion is permanent now. E hat E is going to definitely move in a downward direction, which will shift the AA curve downward. I'll show you the math later, but just trust me, the AA curve has to shift downward. But it can shift, it can shift all the way down here in which we get zero output. It can shift a little bit downward in which we do get an output. So the question you should be asking is, how much do we shift, right? That's not an obvious, it's not obvious to me at least, how much the AA curve has to shift downward. So we're going to first assume that the AA curve doesn't shift as much as we think it should. I mean, all the way down to zero. So suppose we have positive output effect. Suppose it's somewhere here. So suppose we have a positive change in Y. That's the final equilibrium. To achieve this from this starting point, we have to have a scenario in which the change in E is not as dramatic as the change in expectations. And you'll see this graphically soon, but the idea is the thing. The idea is the following, right? So far up to this class, if you haven't noticed, if X spec changes in a certain direction, then E has to move proportionally to the same direction. That's just math, okay? To get to this point here, so that AA schedule doesn't fully drop to wipe out output, that's only possible if E doesn't decrease as much as our expectations. In which case, E hat E minus E over E is going to be, so this is super negative, and this is a little bit negative. This is bigger than this, so this is going to be negative. You agree? So suppose this is our, again, this is our starting point. Suppose E hat E equals E, but E hat E, our expectations decrease a lot, right? It decreases a lot, but our actual spot rate only decreases a little, so that we can actually get an output effect. This is just graphically it must be true. That implies that whatever level they were at, if E hat E is super low and this one's decreased a little bit low, then it's a small number minus a big number. So this is our first conclusion based on the assuming that we have a positive output effect. So step one, assume we have a positive output effect. We notice that if that's true graphically, this must be true. Graphically, the spot rate cannot decrease as much as E hat E decreases. And the relative difference tells us that E hat E minus E must be negative. Step three, we notice that if there is an output effect, we know from our T model, if we have an output effect, we must have higher interest rates, right? And we know if R is greater than R star, then in equilibrium, the expected depreciation of the home currency, this term must be positive, right? In order to equilibrate, in order to make this equal, right? This has to be equal. This R must be equal to R star plus some term, right? Because, again, our starting point is R equals R star, right? But now R has increased in value with an output effect. So in equilibrium, after carry traders come in and do their stuff, E hat E minus E must be positive. So step 4, notice that 2 and 3 contradict each other. So 2 is incongruous with, so I think the mathematical expression is like this, right? They conflict with each other. And so, final conclusion, no output, no change in output. Because that was our initial assumption, right? We assumed there's an output effect. All right, messy, I know. So let me start over, okay? We want to know, objective, we want to know if a permanent fiscal expansion yields positive output in both the short run and the long run. And we're going to analyze this question with this starting point. So suppose we are in an equilibrium in which the spot rate is equal to our expected future spot rate, in which case R must equal to R star. Agree? Because we know that E hat E minus E over E equals to R minus R star, right? We know that, right? That's UIP. So given UIP, if E hat E equals E, then R equals R star. Okay. So step 1, we assume what we want to prove. We want to prove that there's an output effect. So let's assume that there is an output effect, and we draw some conclusions with that assumption. So assume there is an output based on the graph. That means that the AA schedule has to shift because the output effect is permanent, and we expect a we expect that, and that has to be reflected in the expected E hat E, right? But in order to actually get an output effect, that would mean that the spot rate can't decrease as much as what we expect the future spot rate. Our expectations, the decrease in our expectations has to be larger than the actual change in the spot rate today. So if we were to write it in this fashion, right? So imagine that E hat E and E are the same level, but E hat E has decreased a lot, but E decreased a little. Then the difference between those two is going to be a negative number. So our conclusion, just based graphically, right, is that E hat E minus E over E must be a negative number. That means the expected depreciation of our currency is going to be negative. All right, step 3, we notice also that an output effect, increase in Y, can also be analyzed in this format, right? In our financial markets equilibrium, which tells us that if you have an output effect or increase in Y, then interest rates have to increase as well, right? Because people are wealthier, they want more liquidity, they're gonna sell some of their bonds. Selling bonds push down bond prices, bond yields increases, so R has to increase. But if R prime is greater than R star, you know that UIP restores its parity when the expected depreciation becomes positive, right? Because R prime is now greater than R star, which means that E hat E minus E, right? This is the premium now, right? This is the premium for holding other foreign currencies. That premium has to be positive. So the next step, we notice that 2 and 3 cannot coexist, right? They are at odds with each other. They contradict each other. And therefore, our initial assumption of a positive output is wrong. And we are forced to conclude that the change in Y is equal to 0. Okay, no change. So yeah, change in Y equals 0. So these are the steps that's outlined here. I mean, verbal. I gave you the pictures. I emphasize it's only clear like this if we have that starting point E hat E over E. If that is not our equilibrium starting point, then you just get a really crowding out. You get an amplified crowding out effect, right? So that just means that your fiscal policy is going to be very weak, especially if it's very unexpected, right? So let's show you what that looks like graphically. This is the AA. This is the DD. ED is represented by following. P star of a P. And the AA. That's R star. Let's see. Okay. So first things first is shift in DD, right? We know that because that's fiscal policy. That's this gap here, right? That's plus G or minus C delta T, right? That's fiscal policy. And we know that AA has to decrease. Why? Why does it decrease? Well, if there's an output effect, right? That means that liquidity preference increases, and we need to offset this, which means that interest rates have to rise, and they rise if E gets stronger. Sorry, domestic currency gets stronger. in which case we have to wipe everything out. So that's our conclusion, right? There we go. Okay. This is A prime. Now we have this. Makes things harder, right? So this decreases from this. Okay, sorry. This pressure means that we're moving downward here. So this is our short run and long run equilibrium. And this is assuming starting equilibrium is E hat E equals E. So without the change in expectations, no change in A schedule, right? In which case, as you shift the DD schedule to the right, the increase in Y will have a dampening effect on E, correct? That's this equilibrium here. That is not our equilibrium under the permanent case, however. In the permanent case, we have expectations shifting to A schedule. A schedule, as we know from this proof here, it must shift down to wipe out output completely if our starting point is here. And so the takeaway E depreciates and no output effect. PPP does violated in both short run and long run. So all you get is a stronger currency and nothing else. So this is E naught and this is E prime. So I emphasize here, it's a change in, it's either plus G or minus delta CT as well as a decrease in E hat E, right? So two things, right? This is the permanent effect. This is the fiscal policy. The fiscal policy is the shift in the DD curve. Expectation shifts the A curve downward. And it shifts down as much as possible to wipe out output because that is our conclusion here. An output effect cannot hold. Otherwise we get a contradiction. So if we are not, so on an exam, if you do the analysis of a permanent fiscal policy, go ahead and just assume our starting point is here, because otherwise it's messy. So why is this important? Well, sometimes all you want to do is devalue your currency to hit a target, right? And this is good enough, right? So if you're a country and you want to devalue or strengthen your currency to a certain point, that's something fiscal policy can do, right? You don't get any output effect, but you get your desired, target for current account or currency value, exchange rate value. So I'll go over the proof again when I summarize what we learned today. All right, so long run, let's just see previous slide. Right, because we know what the long run scenario is, right? Long run and short run are the same. All right, to summarize. So under floating exchange rates, right? That's again what we've been analyzing so far, building all this model. We assume that all countries don't manage or peg their currency, their exchange rates. They allow it to float. And all they're really concerned is how to manipulate fiscal and monetary policy to see how that translates to changes in output through the exchange rate, right? That's the whole point of this analysis. What role does the exchange rate play in affecting output coming from monetary and fiscal policy? We learned that temporary policies do work for both monetary and fiscal policy. They work especially well for monetary interventions, but not so well for fiscal interventions because there is a competing crowding out effect, right, coming from the current account. The strengthening of the currency undermines domestic trade competitiveness, which undermines output, right? That's why fiscal policy is not the desirable tool under this model, right, compared to monetary policy. The problem with short-term policy is that they don't last into the long term. They're not forever. In the long term, everything is reversed. In the long term, permanent monetary policy is actually quite good in the short run because you get that unexpected bump, right? The overshooting, which does translate to exaggerated output effects. In the long run, as you get the reversal, as prices catch up to the change in money supply, you get inflation. I mean, you get a devalued currency, but you get relative PPP holding, right? You get the Q not changing in the long run. All right, and for fiscal policies, yeah, fiscal policy is not very effective, right? As you saw from the special case in which we're in the equilibrium in which E hat E equals E. If you assume there's an output effect, you must conclude there's a contradiction, right? So you can only conclude there's no output coming from a permanent fiscal policy intervention. So before we conclude today, let me summarize what we learned and again walk you through the proof, just in case people were lost. So this slide, you can memorize it. This just tells you how to shift the curves, okay? So far we assume floating exchange rates. We assume prices are sticky in the short run, which means PPP will fail. And domestic policies do not influence R star or P star. And the plot that we're focused on is E versus Y. Okay, so how do you shift curves on this graph? Well, as long as we're not changing E or Y, some curve has to change. For the DD schedule, my suggestion is to hold E constant and then see how Y changes, given a change in something that's not E. So in the case of G, right, you change G upward, D has to increase, Y has to increase to equilibrate, right? And so for a given E, a higher G must demand a higher Y. For T and P, it's the opposite. The reason why is because T has a minus sign here and P is in the denominator. For the AA schedule, again, same idea. As long as you're not changing E and Y, something has to change, has to shift. So if we hold Y constant in this case, a change in, for example, MS will require you to shift curve by looking at how E changes. So in this case, if you change MS, you have to have an increase in E, which means that the A schedule has to shift upward. Okay, so the key parameters here are MS and E hat E, right? That's how you get the amplification effect on the change in E. For temporary monetary expansion, let me walk you through the logic. So if you're given a single starting point output and you have an increase in money supply, that's gonna lead to a disequilibrium, right? And we need to find some way to restore it. That's only restored if E increases or the domestic currency is devalued. This requires us to shift the AA schedule upward. I'll show you the graph on the next slide. In fact, the shift is even stronger if it's unanticipated And this is driven by the fact that there's open market operations by the central bank to buy domestic bonds, which pushes interest rates down. But as E increases, that's going to feed back into the aggregate demand equation, which makes our exports more competitive, right? In which case Y has to move towards restoring equilibrium, right, from the left-hand side. And this is driven by the following mechanism. Domestic exports relatively cheaper, volume effect dominates, and therefore domestic consumption also increases here, right? So some feedback. But the feedback that really matters comes from the fact that the increase in Y feeds into the money market, financial market equilibrium, in which case you have an increase in Y just means that the E doesn't have to increase as much anymore, right? So we're moving along the A schedule. So the new equilibrium is when both is a point in which the AADB schedule intersect after shifting the curve. So if you look at the graph, that's what it looks like, right? You go from here, you jump to here, but you notice that for this E, it drives output. Output will move this way, right, this way. But as you move down, you realize that E doesn't have to be as depreciated as much as you need before. And so as long it will stop strengthening until you arrive at a combination of E and Y that satisfies both schedules, right? For fiscal expansion, this is the following sequence of logic. If you're going to expand fiscally, that's either through government spending or tax cuts, that's going to increase aggregate demand, which means that Y will increase to restore equilibrium. So holding E constant, right? We shift the DB curve to the right because it demands a higher Y for any given E, which means that domestic consumption increases and perhaps public investments also increases. With an increase in Y, that's going to feed back into the money market equilibrium plus UIP equation, distorting it in such a way that the right-hand side is greater than left-hand side. How do you restore equilibrium? All else equal, the only other parameter we can change is E, and it has to move in a direction that lowers Y, which means interest rates have to rise, and that's only possible if E decreases, so stronger domestic currency. What's the mechanism? It's doing it this way because more income increases liquidity demand, right? People are selling off bonds and interest rates are increasing. But with E decreasing, E is going to feed back into the aggregate demand function through Q, right? This is where the crowding out effect comes in. So with Q decreasing, current account decreasing, exports are no longer as competitive anymore, then Y has to decrease to meet demand, lower demand. So the more E decreases, the less Y has to increase. And so the current account effect crowds out the output effect. And it's really, really bad if E hat E is changing as well, unanticipated, right? Because you have to shift the AA curve too. So let's look at the just temporary case, right? Temporary case, you're moving from this point to this point, right? So again, it's from the fact that you're feeding back, the output is feeding back into A is making E stronger, and as E gets stronger, output is dampened. So you don't get this effect, you only get this effect, right? So this is the full potential. This is the dampened version. For a permanent monetary expansion, the only difference is that there's overshooting, and now you have the DD's schedule shifting to the left because prices are rising over time. But E will also trace P, which will wipe out all output effect on aggregate demand. So the change in Y is going to be 0. So let me just show you the graph first, perhaps. Yeah, the graph. So getting to here, I think it's obvious, right? Because you have a change in MS, but also a change in E hat E. So you get the super upward shift AA schedule. But there's a reversal, because in the end, in the long run, the only thing that's going to be reflected in the equation is the change in E hat E, right? So that's this point here, perhaps, okay, this point here. But the shift from DD to DD prime is due to the fact that we have increase in prices, which will undermine Q, right? That's why it shifts to the left. But as P increases, E will also increase by the same amount. And over time, relative PVP can hold, right? Because there's no change in Q. Change in Q is equal to 0. So you get 0 output. So here, I think it's straightforward. MS and E is changing, so you have E increasing, Q increasing, Y increasing, and then there's a fact that as output increasing, you're going back towards you're moving along the AA schedule, and so that's why you arrive here. So our original was here, right? From here to here, from here to here. Long run is the following. You overshoot, there's a reversal, prices are flexible, prices decreases in the short run, increase in prices, so E only responds to E hat E, yes, so that's why we go to A double prime. And for prices increasing, that's going to shift DD schedule to the left, right? And as you feed back, then E will trace P, right? In which case there's no output effect. All right, lastly, the most complicated proof, I think, for today. So the way to prove this is first note that the fact that it's only a special case in which we are assuming that we're in equilibrium, which expectations on the spot rate is equal to the spot price. And once we have that starting point, you prove this by contradiction, meaning we assume what we want to prove, and then realize that what we want to prove, or what we assume, will lead to contradictions. And so we are forced to conclude the opposite. So here, assume there's no output effect. I'm sorry. Assume there is an output effect, sorry. And we note that there's two things we can conclude from this. So first, we realize that if E hat E equals E, that means that expectations, if it decreases, E can't decrease as much. So even though they're starting at the same level, E hat E must decrease more than E hat E must decrease more than the spot rate itself. So if you were to write any difference in this fashion, then it has to be negative, right? The new values, at least after the decrease. The second thing you note is the fact that if there is an output effect, then we know that interest rates have to be higher, right? So these two interest rates are at parity only if there is a premium, right? This premium has to be positive in order to restore equilibrium. With this term being positive and this term being negative, you realize there is a contradiction, right? There's a contradiction. Therefore, our initial assumption of a positive output is wrong. Cannot be true. Therefore, relative PVP cannot hold in both the short run or long run. There's Q changes, no output. Yeah. So here's the graph. So assume that our starting equilibrium is the following. So assume this point here, right? It's this. So if that's true, then this shift comes from the fact of plus G or minus minus C delta T. But this shift is due to the fact that the change in E must decrease the same as the change in E hat E. And we're forced to have zero output because of the proof we showed you before. So all we get in the end is just a stronger currency, right? And zero output effect. Okay, so that's it for today. So next week is fixed exchange rates, and then we're done. Okay, and then I'll just talk about, getting out of how does one get out of the zero lower bound problem. So maybe you noticed that Japan actually cut its interest rates down to zero before, and the US has done so before. And if you can't cut interest rates to negative, practically speaking, because people will just take their money out of banks and put them in vaults, right? Because nobody wants to hold their money and earn a negative interest rate. And so that's why it's called a zero lower bound problem. So there is a exchange rate solution to get out of the zero lower bound problem that I'll talk about next week. Yeah, so that's the plan for next week, and then after that, it's risk management until the end of the semester. Okay, that's all I have for you today. So I will make an announcement today or later tonight or tomorrow morning about this midterm self-correction because I forgot to mention it. But just remember, the deadline is this Sunday, right? So the 17th is there. So you have until midnight. So I'll make an announcement tonight so that it's fair between the other class, even though they have class on Thursday. Okay. So as long as you make an attempt to correct your mistakes, I will reward you with 2 points on your exam. Okay. All right. See you guys next week.